It is a Tuesday morning in January of 2032. You wake up, you make coffee, you sit down at the kitchen table, and you open your bank account on your phone, the same way you do every month when your Social Security deposit arrives. The deposit is there, but it is not the amount you expected. It is smaller, noticeably smaller, and it is not a banking error. It is not a glitch. It is a letter from the Social Security Administration explaining that effective this month, your benefit has been reduced by 23% under the automatic reduction provision of federal law. Nobody called you. Nobody warned you individually. Nobody in Washington sat down with you and explained what was coming. The check is just smaller, and it will be smaller every single month for the rest of your life. For the average American retiree, collecting $2,081 per month, that is $479 gone every month. $5,748 per year. Over a 20-year retirement, $114,960 that was supposed to be yours, that the system promised you, that you paid into for 30 or 40 years. Gone. Not because you did anything wrong, because Congress did nothing right. That scenario is not a political opinion. It is not fear-mongering. It is the mathematical projection published by the Congressional Budget Office in February of 2026, the nonpartisan federal agency whose job is to calculate exactly this kind of outcome. And here is what makes this video different from every other Social Security video you have seen. I am not going to spend 20 minutes telling you to panic. I am not going to tell you to claim at 62 because the money is running out. I am not going to tell you that Social Security is going bankrupt. What I am going to do is show you the exact legal and tax framework behind this cut, translate the real dollar impact for your specific income level, explain the 3 mistakes most retirees are already making in response to this news, mistakes that will cost them far more than the cut itself, and give you the 5 specific moves that protect your household income, whether Congress fixes this or not. Because the people who come through this clean are not the ones who panic. They are the ones who prepared. Let me start with the facts. Just the facts. The Social Security system is funded primarily through payroll taxes. Workers pay in. The money goes into the Old Age and Survivors Insurance Trust Fund, the OASI. That fund pays current retirees. For decades, more money came in than went out. The trust fund built up reserves. That changed. The baby boomer generation began retiring in large numbers. Fewer workers are supporting more retirees. Annual deficits, the gap between what comes in and what goes out, have been growing every year. The trust fund reserves are being drawn down to cover the gap. When those reserves hit zero, which the Congressional Budget Office now projects will happen in fiscal year 2032, federal law automatically limits Social Security payments to the amount coming in from current payroll taxes. That amount covers approximately 72 to 77% of scheduled benefits, which means an automatic 23 to 28% reduction in every benefit check, not just for new retirees, but for everyone currently collecting. Let me be precise about the timeline, because it has gotten worse. In 2024, the projection was that the OASI Trust Fund would be depleted in 2033. In June of 2025, the Social Security Trustees Report moved that date to 2034 when combined funds are considered, or 2033 for the OASI fund alone. Then, in February of 2026, the Congressional Budget Office released updated projections showing the depletion date has moved to 2032, 1 year earlier than the trustees' own estimate. Why did it move earlier? 2 reasons. First, the One Big Beautiful Bill Act, signed in July of 2025, reduced income tax revenue. Social Security receives a portion of its funding from taxes paid on Social Security benefits themselves. Lower income taxes mean less revenue flowing back into the trust fund. The SSA's chief actuary estimated this legislation added $168.6 billion in additional Social Security program costs between 2025 and 2034, moving the depletion date forward from the first quarter of 2033 to the fourth quarter of 2032. Second, demographic pressure. The number of Americans over 65 is nearly 3 times what it was 50 years ago. That trend does not reverse. So the honest timeline is this: 6 years. The Congressional Budget Office says 2032. The trustees say between 2033 and 2034. The difference between those estimates is not comfort. It is the difference between 6 years to prepare and 8 years to prepare. Either way, this is not a distant problem. This is a retirement income planning problem that affects every American currently collecting Social Security and every American within 15 years of collecting it. Now let me show you what the cut actually means in real dollars for different income levels, because the percentage is abstract. The monthly check is real. The average Social Security benefit for a retired worker in 2026 is $2,081 per month.
A 23% cut reduces that to $1,602 per month, a loss of $479 per month, $5,748 per year. If you are collecting the maximum benefit of $5,181 per month, a 23% cut takes that to $3,989 per month, a loss of $1,192 per month, $14,304 per year. For a married couple where both spouses collect the average benefit, combined loss of $958 per month, $11,496 per year. Over a 20-year retirement, $229,920 in lost income. The Committee for a Responsible Federal Budget put the impact on a typical dual-earning retired couple at approximately $18,100 per year in lost benefits. That is not a rounding error. That is a car payment, a mortgage payment, a prescription budget, a grocery budget. Gone. Every year for the rest of your life. And here is the part that most of the coverage gets completely wrong. They tell you not to panic. They tell you Congress will fix it. Here is what they are not telling you. Congress fixed Social Security once before, in 1983, the Greenspan Commission. And here is exactly how they fixed it. They raised the full retirement age from 65 to 67. They increased the payroll tax rate. They began taxing Social Security benefits as ordinary income for the first time in history. Every single one of those fixes was paid for by retirees and workers. Not by Congress, not by the government. By you. The 1983 fix introduced the combined income formula that now causes up to 85% of your Social Security to be taxable. That was the fix. You have been paying for it for 40 years. When Congress fixes this one, and they likely will eventually, the fix will once again come at a cost to someone. Higher payroll taxes on workers, higher retirement age for future retirees, more aggressive taxation of benefits, means testing that reduces or eliminates benefits for higher income retirees, some combination of all four. There is no version of the congressional fix that costs nothing. The only question is who pays and when. That is the context you need before we talk about what to do. Now let me walk you through the 3 mistakes that retirees are already making in response to this news. Because the wrong response to this cuts your lifetime income more than the cut itself. Mistake number 1. Claiming Social Security early out of fear. This is the most common and most damaging response to the trust fund news. The logic sounds reasonable. If benefits are going to be cut anyway, I should take the money now, before it disappears. Here is why that logic fails mathematically. If you claim at 62 instead of your full retirement age of 67, you permanently reduce your benefit by approximately 30%.
The projected trust fund cut is 23%. You are voluntarily taking a 30% permanent reduction to avoid a possible 23% cut that may never arrive at full severity if Congress acts.
And critically, if Congress does act and benefits are protected, you have locked in a 30% reduction for the rest of your life for no reason at all. The math on early claiming out of fear is unambiguous. It is almost always the worst outcome. The 36% of non-retirees who told the Schroders 2025 survey they were planning to file early specifically because of trust fund fears, almost all of them are making the single most expensive financial decision of their retirement based on emotion rather than math. Mistake number 2, doing nothing and hoping Congress fixes it. The opposite of panic is not passivity. The congressional fix, when it comes, will not be designed to protect your individual household income. It will be designed to extend the program's solvency across 330 million people. If you are currently 65 and collecting $2,000 per month, a fix that raises the retirement age to 68 protects you. You already cleared the threshold. A fix that means tests benefits at $80,000 in retirement income may directly cut your benefit if your IRA withdrawals and pension push you above that line. You do not know which fix is coming. You do not know which combination Congress will choose. The only thing you can control is how dependent you are on Social Security as a percentage of your total retirement income. The households that come through this cleanest are the ones where Social Security is one of several income sources, not the only income source. Mistake number 3, restructuring everything based on the worst-case scenario. The worst-case projection, 28% cuts starting in 2032, deepening through 2036, assumes Congress takes zero action for 6 years. That has never happened in the history of the Social Security program. Congress has always acted, though sometimes late. Making irreversible financial decisions based on the worst-case scenario, liquidating tax-advantaged accounts, dramatically changing investment allocations, buying expensive annuities out of panic, can cause more damage to your lifetime income than the cut itself. The correct response is measured preparation, building income flexibility, not panic restructuring. Now, here are the 5 legal moves that protect your household income. Legal move number 1. Stress test your budget at 77 cents on the dollar right now. This is the most important thing you can do before any investment or tax decision. Take your current Social Security benefit and multiply it by 0.77. That is your reduced check in the base case scenario if the trust fund depletes and Congress does nothing. Can your household cover its essential fixed costs, housing, healthcare, food, utilities, at that reduced income level? If yes, you have genuine flexibility in how you respond to this. If no, you have identified a specific income gap that needs to be filled by another source before 2032. Knowing the exact size of that gap is more valuable than any amount of political speculation about what Congress will do. Legal move number 2. Accelerate Roth conversions now while tax rates are lower. The One Big Beautiful Bill made the lower TCJA-era tax brackets permanent through 2028. After 2028, brackets revert to pre-TCJA levels unless extended again, meaning tax rates on IRA withdrawals and Roth conversions are likely lower right now than they will be in 2030 and beyond. This creates a specific window, 2026 through 2028, where converting traditional IRA money to Roth at 22% is almost certainly cheaper than converting at 25 or 28% later. The strategic reason this protects you from the Social Security cut is direct. Roth withdrawals do not count as income for the Social Security taxation formula. The combined income threshold that determines how much of your Social Security is taxable,
$25,000 for single filers, $32,000 for married couples, is calculated before Roth distributions.
If your IRA is fully or substantially converted to Roth before the potential cut hits in 2032, your supplemental income from Roth withdrawals does not push more of your remaining Social Security benefit into taxable status. Your effective loss from the cut is smaller because less of your reduced benefit is being taxed. Legal move number 3. Maximize the senior bonus deduction before it expires. The $6,000 senior bonus deduction, created by the One Big Beautiful Bill, is available for tax years 2025 through 2028. It expires after 2028. This deduction directly reduces your combined income for the Social Security taxation calculation. For many retirees, claiming the full senior bonus deduction is the difference between having 50% of Social Security taxable versus 85% taxable. In a scenario where your benefit is already reduced by 23%, having more of the remaining benefit protected from taxation is directly valuable. Make sure this deduction is on your 2025 and every subsequent return through 2028.
Legal move number 4. Build one alternative income source that you personally control. The structural vulnerability that the trust fund depletion exposes is over-reliance on a single government income stream. The solution is not complicated. It is not dramatic. It is building one additional income source that is not dependent on congressional action. This could be a qualified dividend-paying portfolio in a taxable brokerage account, a small rental property generating monthly income, a part-time consulting arrangement drawing on your career expertise, a structured annuity providing guaranteed monthly income independent of Social Security. The target is not replacing Social Security entirely. The target is having enough supplemental income that a 23% reduction in your Social Security check does not destabilize your essential expenses. Even an additional $500 per month from a source you control changes the entire calculus. It is the difference between a Social Security cut being painful and a Social Security cut being manageable.
Legal move number 5. Coordinate your claiming age with your Roth conversion strategy. This is the move most financial advisors miss entirely when discussing the trust fund problem. Your claiming age determines your starting benefit amount. Your Roth conversion strategy determines your taxable income in the years before you claim. These two decisions interact directly. If you delay claiming to 69 or 70 to maximize your starting benefit, and you use the delay years to convert aggressively to Roth at low tax rates, you arrive at your claiming date with a larger benefit and a substantially Roth-heavy portfolio that minimizes taxation of that benefit going forward. If the trust fund cut hits and your benefit is reduced by 23%, a higher starting benefit means the reduced amount is still larger than the reduced amount would be if you had claimed early. 23% of a larger number is still larger than 23% of a smaller number. The math is simple. A $2,500 benefit reduced by 23% is $1,925. A $2,000 benefit reduced by 23% is $1,540. The person who delayed starts with $385 more per month, even after the identical percentage cut. Claiming strategy and Roth conversion strategy are not separate decisions. They are one coordinated decision that should be modeled together. Here is your action plan for this week. Step 1. Look up your current Social Security estimated benefit at ssa.gov. Multiply it by 0.77. Write that number on a piece of paper. That is your stress test number. Step 2. Pull your last tax return. Find your adjusted gross income. Calculate whether you are above or below the senior bonus deduction income threshold. $75,000 for single filers, $150,000 for married couples. If you are below it and you have not claimed the deduction, you are leaving money on the table this year. Step 3.
Calculate how much of your current retirement income comes from Social Security as a percentage of your total household income. If that number is above 50%, you have a concentration risk that needs to be addressed before 2032. Step 4. Drop a comment below right now with one number. What percentage of your planned retirement income does Social Security represent? Is it 20%, 50%, 90%? That single number tells you everything about your exposure to this cut. I read every comment and I respond to every single one. We will work through your specific situation together. The Social Security Trust Fund problem is real. The CBO projection is not political. The math is not speculative. But the households that come through this without a catastrophic income disruption are not the ones that panicked in 2026. They are not the ones that claimed early out of fear. They are not the ones that moved everything into gold or annuities based on the worst-case headlines. They are the ones that stress-tested their budgets, converted their IRAs while rates were low, claimed the deductions that were available, built one income source they personally controlled, and coordinated their claiming age with their tax strategy. 6 years, possibly 8. That is the window. The IRS did not build the Social Security taxation formula to protect you. The trust fund math does not care about your individual retirement plan. The only person in this equation who is looking out specifically for you is you. Subscribe for a new video every Thursday. Next week, I am walking through the 7 hidden rules of the Secure 2.0 Act that most retirees have never heard of. Rules that are already triggering IRS penalties in 2026 and generating surprise tax bills that nobody warned you were coming. Drop a comment below. Tell me, are you currently collecting Social Security or are you within 10 years of claiming? Tell me roughly what percentage of your planned retirement income Social Security represents. I want to know. I read every single one.